The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And we're going to be talking about money once again. We'll start the program off. I've got so much to cover today. We've got so much to go through. We've got so much. I have a great guest today who's got a tremendous story to tell. So you want to hear what he has to say. But I want to start by asking a question. I want to take you back to World War II, to one of the issues that cropped up then. The issue was dealing with planes getting shot down, because they wanted to know, the generals wanted to know, the military wanted to know on those planes how to armor the planes so that they reduced the number of planes that were shot down. If you put too much armor on the planes, you slowed them down. If you put too little, they were easily shot out of the air. 5% was a huge difference. 5% meant the difference between winning and losing. So they did a study, and they came back with looking at the planes which had returned and the bullet holes in the planes that were returning. And what they found, they divided the plane into 4 different sections. They divided it into the engine, the fuselage, the fuel system, and everything else, the wings, the tails, and so on. And for the planes that had gone out on a mission and then returned, they measured the number of bullet holes in the plane. And they found that the engine had the fewest number of bullet holes, only 1.11 bullet holes for every square foot of engine surface for the covering of the engine, only 1.1. The fuselage, on the other hand, had 1.73, significant difference between the fuselage and the engine. The fuel system had 1.55, again, much more than the engine, not quite as much as the fuselage. And the rest of the plane was 1.8. The rest of the plane was the worst. So the question is, what would you do and how would you change the armor of the plane, knowing that too much armor is going to slow things down and result in a loss? Too little is going to give too little protection, and the plane's going to get shot down. Where would you armor the plane to make it more effective? Keep it in the air longer. Keep that in mind, because we're going to come back and visit that. I'm asking the question now so you can think about it and come up with your ideas. But I want to shift gears now. And maybe today is a math day, because I want to talk about a game. And I have another question for you. While you're thinking about where would you increase the armor on the plane or decrease, I want you to think about, or shift the armor around. Maybe you shift it from one section to another section. What do you think? But before we get there, I want to talk about a game. This is a game where you've got to hang with me right now. I've got a coin. I'm going to flip the coin, and you got to pretend that you're starting with $20. You start with $20, and I'm reaching in my pocket right now trying to find a coin. I know I had a coin in here somewhere. I've got car keys. I've got office keys. I'm trying to find a coin. I'm sure that I had a coin. I have a penny, but I had a quarter. There's the quarter. I found the quarter. Okay, now we're on. Okay, the idea is I'm going to flip the coin, and you've just got to believe when I say I'm flipping the coin, what it comes down. So you have to pretend that you have $20, and that every time the coin comes down heads, you win $2.50, and every time it comes down tails, you lose $1. Got that? So every time you get a heads down on the coin, you get $2.50. every time it comes up tails, you lose $1. So we're starting with $20, and I've got the coin in my hand, and I'm flipping it now, and it comes up heads. So now you have $22.50, and you have a choice. Are you going to play, or are you going to quit? You're ahead now. Think about that. Going to play or going to quit? You're ahead now. We'll flip the coin again. Oh, this time it's tails. So you now lost $1. You would have been better ahead if you would have kept the $22.50 rather than where you are now. You're just $21.50. Are you going to play? Or are you going to take your money and go? You're at a profit now. You're going to take your money and go, or are you going to play? So if you said you're going to play, I'm going to flip the coin again, and we're tails. You lost another $1. Now you're down to $20.50. You're only ahead 50 cents. Are you going to continue to play? Or are you going to take your 50-cent profit and go? Got to make its choice. Continue to play or go. So if you decided to play, we're going to flip the coin again and see how we come out. We got heads. So now you got $2.50. Now you're at $23. Now, are you going to continue to play, or are you going to take your profit and go? You've got a $3 profit now. Going to continue to play, or are you going to go? If you decide you're going to go, that's fine. If you decide you're going to continue to play, we're going to flip the coin once more. Oop, it's tails. You lost $1. You're back to 22. So do you take your 22 and go? You're at a profit. Or do you continue to play? If you decided you're going to continue to play, we're going to flip again. It's tails. You're at $21. Continue to play or go. So that's the game. The idea is there's 20 plays, and every time you win, you get $2.50. Every time you lose $1. What's the optimum strategy? The optimum strategy is to play every single time. If you play every single time, there's only a 13% chance that you end up losing money. There's an 87% chance that you're going to make money or at least break even. Over 70% of a chance you're going to make money. But when most people did that, most people, when they either get ahead or get behind after a few plays, within 5 plays, the majority of people, a large 70% of the people will quit within 5 rounds of playing. And over 50% will quit before the last 5 rounds. 50% of the remaining 30%. Only 15% of the people will continue to play. That illustrates what we went through in 2007, 2008. There were a lot of people who watched the market go down and watched their values go down and decided to take their money off the table. And maybe they were ahead. Remember we flipped the coin the first time and you won, you had $22.50? Some of those people were very happy, but then when they got to the first loss or second loss, instead of taking the profits and going, they continued on. But once they were down, and sometimes you'll be down in this game, sometimes you'll be at $19 or $18, people will take their money off the table and go at a loss. That's what happens in a bear market. People get scared. I didn't have very many calls during the bear market. Most of my clients had been through the .com, or they'd been prepared for going through this period of time that when people get worried. I had about 1 call every quarter, and most of the times people were calling me to say, are you feeling okay? It wasn't, what about my account? Because we were well prepared. We were ready to go through this. We knew 2 things. Either stocks were going to go to zero, and if they go to zero, it doesn't matter whether you took your money off the table or not. The economy is dead anyway. or you left the money in and there was a recovery. It wasn't just taking the money off and getting back in, because most of the people that took their money out of the market waited way too long to get back in. They waited and waited and waited. You know, as we're going through this time now, you have people talking about this is a bull market that's very old. It's going to die of old age. Bull markets don't die of old age. But fear continues to come up, and fear will continue to come up. You know, there's worries over North Korea. There's worries over China. There's worries over Russia. There's worries that consumers are now taking on more debt. There's worries about oil prices. There's worries about the economy. There's worries about unemployment. There's all those worries that are going on. The stock market climbs a wall of worry, and it will continue to climb a wall of worry as long as we're around, as long as we're in a bull market. People will have things to worry about. It's when they quit worrying about anything that you have to start to worry. You want to be greedy when everyone else is fearful, and you want to be fearful when everyone else is greedy. That's a Warren Buffett thing that served him well and serves me well and should be serving you well as well. We're going to continue this right after the break, and we are coming to commercial break, so don't go away. We've got more to talk about. And I want to know where you would put the armor on those airplanes. We'll be back.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
Products they offer.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I want to talk about the armament of the plane. But before that, I want to let you know we've got a great guest coming up. You want to hear what he has to say. And in the last segment, I want to talk about something that was very, very significant. Happened 3 years ago on the 4th of July, not in this country, but in Europe. A very, very significant event. So anyway, I'll be talking about that in the last segment, so don't go away. We've got a lot to cover. So I want to come back. A book written called How Not to Be Wrong, The Power of Mathematical Thinking by Jordan Ellenberg. He was the one that pointed out a statistical research group, top secret group, just like the Manhattan Project that developed the atomic bomb. This was a top secret group. It was a group of statisticians. It was set up to look at questions like the aircraft. How do you armor the aircraft to make them the most effective? Maximize the probability that the aircraft are going to win. And remember, the issue was this. They were checking the planes that were returning from action, and they were looking at the bullet holes. And the bullet holes, they found that the engine had the fewest bullet holes per square feet. The fuselage had 1.7, the engine compartment 1.1. The fuel system had 1.5, and the rest of the plane, the wings and the tail and so on, was 1.8 bullet holes per square foot. And the question they were asking is, where do you add or subtract armor to make the planes more effective. If you do too much armor, they're slow and you lose. If you do too little, they're not protected enough and the planes go down. 5% difference was enough to make a difference between winning and losing the air battle. And they gave the question, what should they do with the armament? And they gave that question to the statistical research group. And they came back, what was your answer? Pose the question at the beginning, what was your answer? Well, the reality is, it's not logical. Or when you think about it, it is logical. These were the planes that were returning that had not been shot down. It wasn't where the bullet holes were. It's where the bullet holes weren't. Because the plane, there should be statistically no big difference between where the bullet holes were. There should be this equal number in the engine compartment as the fuselage, the fuel system, and the rest of the plane. And if you look at it, the one area which had the fewest bullet holes was where the engines were. And the conclusion was, that's the place that needed the most armament, because the planes that had received the most bullet holes in the engine were the planes that didn't come back. Proved to be deadly accurate, proved to be right on, and we won a lot of that. It was Abraham Wald, a mathematician, who was picked to do that project, and it was where the bullet holes weren't that made the difference. Many of the generals, many of the people that had this problem were thinking it's the fuselage, it's the rest of the plane. It was anywhere but the engine that needed to be armed. But that wasn't really the answer. And I think there's an application to my industry, because we have a lot of things which people talk about, they sell as part of financial plans, and yet I have real questions as to whether it's real. There's a concept that greater volatility in your stock portfolio or in stocks means greater risk. If you have things that are fluctuating more, it means there's got to be greater risk. You know, the answer to that, I think, is yes and no. You know, on a short-term basis, that's really true. But if you look at it over a long-term basis, and you compare things with little volatility to those things with volatility, you have to ask the question, does volatility really equal risk? Think about it. Think of the idea that a T-bill portfolio is safer than a stock portfolio. Common belief, common knowledge. When people are doing financial plans, and we're going to talk about financial plans in the last segment, when people are doing financial plans, they're talking about a T-bill as being safer than a stock portfolio. But it's only safer for a short period of time. If you look at the T-bill has been around 3% over the long history. Right now it's running 0.5% or a little over 0.5%. But historically it's run around 3%. So let's go back and say you have a T-bill portfolio that you turn over every 90 days, or you ladder it so it turns over every 60 days or 90 days or 180 days, but it's about 3% that you're getting. And you hold that for 25 years. 3%, 25 years. If you start with $100,000, you're going to end up with $222,000. You're going to more than double your money. And it's not going to be volatile. It's just going to click up, click up, click up, click up, year after year, month after month. It's just going to continue to click up over 25 years. On the other hand, if you put it in the stock market, where the average has been 9 or 10%, at the end of 25 years, that portfolio is going to be not $222,000, but $862,000. Almost 4 times the amount it was in T-bills. Now you tell me which is riskier. Now the stock market's going to go up and down. It could go up 10%, 15%, down 10 or 15%. We saw in 2008 a market that went down 37%. But you tell me which is riskier. Which is better for the long term. The T-bill portfolio, 100,000 to 222,000, or the stock portfolio that's 862,000. Even if the 862,000 gets down 30%, you're still talking 600,000 versus 200. What appears to be higher risk is not riskier at all in the long term. In fact, the least volatile investment is the riskier. But if you look at what the mutual fund companies sell, if you look at what financial advisors sell, if you look at what everyone sells, it's what I call the Harry Potter story. You know, it's the wizardry. It's not really true. It's artificial, but it can be very, very dangerous. You know, understanding there are rewards and risk in investing, that brings a question to how well people are doing in their portfolios. If you're focused on the long term, you need to be in something which has greater volatility that's going to yield a greater amount. If you're looking at having a chunk of money that you sold your house and you're going to buy another house and you're going to need the money in 6 months, T-bills makes the most sense because you don't want to take the chance it's going to go down. But if you're looking in a 401k or if you're looking at an investment portfolio, you want to be looking at those things that grow. Up and down, greater volatility, sure. But it's those things which you're looking for in the long term. That's looking where the bullet holes are not. You know, Wall Street and in my industry, we'll look at where the bullet holes are and we'll say those are the most bullet holes. And so those are the places where you want to armor the plane. Would have been dead wrong. And I believe there's a number of people that hit 2008, 2009 that had to work longer because their retirement portfolios didn't reach the values they needed to be or had lost enough values. There were people who couldn't send their children to the colleges they planned to send them to because the children's educational funds were insufficient to do so. There were people that saw their retirement funds dwindle and had to work longer. There are retired people who had to cut their cost of living because their portfolios had shrunk. I think all that goes into the planning, and you need to look at what's true in the long term if you're looking at a long-term investment, not what's true in the short term. We're going to come back and talk about that more after I talk to my guest. My guest is Mark Dorsey of Bonanza. Welcome to the program, Mark.
Thank you, Mike. Honored to be here.
So let's talk about your background. Let's start there.
Okay. Well, prior to Bonanza, I had an import-export floral company called Dorsey Floral, so I've always been an entrepreneur at heart. And about 9 years ago, I met Bill Harding, who's the founder of Bonanza, and partnered up with him and Jordan Phillips to launch Bonanza.
So in the floral business, did you start that in Seattle?
I actually started in Los Angeles. I was working for a much larger company, and they had me opening up a business here in Seattle. And then they had transitioned out of that company. They sold that company, and at that time they were going to leave the market, which I had spent so much time building up. So I saw an opportunity to start a business, and I did. I launched a business, and it grew quite nicely.
And that is Bonanza.
That was Dorsey Floral.
Dorsey Floral. Okay.
And then after Dorsey Floral, then Bonanza, we started that in 2008, and that has grown quite nicely.
It has.
Yes.
So we're going to get to talking about Bonanza right after the commercial break, but we are coming up to a commercial break. So if you've missed any part of this program, some of the other programs, you'll find that on our website. We also tweet, so you can follow us on Twitter, About Money Radio. You can follow my Twitter as well, Mike Adams, AFC. You can like us on Facebook, About Money on Facebook. You can like. I'm getting some prompts here.
We're on YouTube.
And we're on YouTube. You'll find us all those places. So do follow us. Do check us out. You can check the blogs out. You can also contact us and get our e-letter. But right now, we're going to commercial break. When we come back, we'll be talking about Bonanza with Mark Dorsey. I got it right. Right?
For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
Well, I'm here with Mark Dorsey of Bonanza. Let's talk about Bonanza. Tell us what Bonanza is.
So Bonanza is an online marketplace very similar to eBay or Amazon. The difference between Bonanza from an eBay or an Amazon is that we are a very seller-focused marketplace. So our customers are our sellers who list their items for sale on our site. And our tagline for our site is everything but the ordinary. So when you're looking for something that's not mass-produced, that's unique, you're likely to find that on Bonanza, but you're also likely to find normal, non-unique items on our site as well.
So how many items would be listed on the site, for example?
So we have over 25 million unique items for sale on our site.
That's more than I can count.
Yeah, there's quite a lot of variety.
So talk about some of the items that are on the site.
Sure. So we have anything from a vintage belt buckle that you've been looking for that you had as a kid that you wanna get back. We have baseball cards. There's a ton of fashion on our site. Really nice handbags, which are quite expensive. They can really get priced up there. Lots of nice high fashion. Lots of items for your home. Lots of craft work. From people who are listing craft items on the site. Just a really wide variety of unique, non-mass-produced items.
And when you say the focus is on sellers, your customer is the seller I'm assuming that's rather than the buyer. So that changes the way you operate from Amazon, for example.
Yeah, it does. For us, it really makes sense. We saw it as an opportunity. A lot of the marketplaces were focusing on buyers and they were creating policies that served the buyers best. And what we found was that was starting to create a very tense situation for sellers. And sellers were really looking for another outlet that they can call home to sell their items. So what we did was we created Bonanza with sellers, small to medium sellers in mind, and created a platform that was all about them and what they wanted and what was important to them. And in doing so, they in turn came to our platform and wanted to promote our platform to their buyers so that they can make the platform more popular for themselves because they really enjoy using our site.
So when you look at somebody like Amazon, which is huge in Seattle, of course, when you look at them, they collect the information. You go on, you click, and they collect the information. They'll come back and say, we know enough about you that we recommend this. How does that vary with what you're doing at Bonanza?
I think the biggest point for us is that we gather that information too, but we provide it to our sellers so that they can own that relationship with their buyer. And we also provide them with tools to help them promote similar items and help make them more successful in remarketing to their customers.
So you're looking at repeat sales for your sellers rather than cross-selling.
We look for any sales that we can get for our sellers. We love repeat sales. We like first-time sales. We try and do as much as we can for our sellers.
Oh, but I mean, if I make the contrast in the financial services business, the main thing for financial advisors is that they sell mortgages, they sell insurance, they sell financial planning, they sell stocks, they sell bonds, they sell mutual funds, they'll sell ETFs, and so on. They sell a broad range of products. Whereas I'm specialized. I just do investment management and 401ks. So I'm specialized. I'm focused just on those areas, and I'm an expert in those areas. Whereas the normal financial advisor has a wide spread and is cross-selling. Buy a mutual fund, they'll try to sell you a mortgage as well. It seems to me like you fit more what I'm doing with the seller. They have a customer, they can promote what they do, and they're looking for repeat sales.
Absolutely. It's a good analogy.
So we talked a little bit about the items. How does a seller join your site, and what do they go through to be part of your site?
So basically, a seller would sign up just from our homepage. We have a very easy way for them to come on board. Another really attractive thing about our site is that we do not charge any upfront fees. A seller can come to our site and get set up without zero cost to them. So it's zero risk. And we're incentivized when we make a sale for them. So we only get paid when a seller makes a sale on our site. So, we are creating tools and creating a platform so that when a seller does sign up for our site, that we're doing our best to put them in the best position to succeed, because when they succeed, we succeed.
So they have to sell an item for you to take a percentage of that.
Correct.
So they can list all their product line at no expense to them.
Not only that, we also offer easy ways for them to get onboarded. We have importers, where they can import their products from eBay, Amazon, Etsy, Shopify, or also a CSV file, so that they can literally get set up on our site by pushing a button. We would import all that data to our site and get them for sale. Then as they made sales on either platform, we would also synchronize the inventory so that they're not overselling on one platform versus the other. So we're very vested in our sellers, so we want them to be successful not only on Bonanza, but on other marketplaces too.
So you also do something with background. Tell us about that.
So approximately in 2012, we saw, one of our things that we do is we try to create tools to help empower our sellers and help them get the most out of sales. And we saw a trend on our site where people were listing some really neat items, but they didn't have very good high quality photos. And in this day and age of, phones and tablets, having quality photos in e-commerce is really important. So what we did was we created an automatic process that removes the backgrounds from images so that it brings the focus to the product itself. And that's called the background burner. And that's something that we allow our sellers to use for free on our site. And then we also have a premium version that we offer on the site for professional or businesses that want to use it to remove images in bulk. But it's the first solution that removes backgrounds from images automatically.
That's a very big deal.
It's a huge deal. It's a problem that people have been trying to solve for a long time. And we've got 3 patents on it, and we're really excited about the technology. And there's a lot of other people outside of e-commerce that are excited about the technology too.
And that's a huge plus for the seller that's on the site.
It really is. And we find a lot of people, using the tool to improve their images on our site, but also improving images outside of Bonanza as well to help them succeed on other e-commerce outlets.
So in the whole process of sellers coming to your site, then the payments are made in normal fashion through PayPal, through credit cards, and so on. All that is normally done. Yeah,
so keeping the theme with empowering the seller, we allow sellers to select either Amazon Pay or PayPal, which are two very well-known and trusted payment sources. And then when the transaction happens, the buyer actually pays the seller directly. So we don't really even have a hand in the financial portion of the transaction. It's between the buyer and the seller, which is how the relationship should work. And then at the end of the month, we bill them for our fees.
So since the seller has the customer's information, which is not true on some of the other sites, since the seller has the customer information, can they then market directly to the customer?
Yeah, they absolutely can. But we found that not a lot of sellers really know how to use that information. They may have an email list. They may have some tips, on how to do that. But we found that there was a need for tools to remarket to their customers. So we've actually created a whole platform on our site that helps them retarget to their shoppers, and we let them know when they have a shopper that comes to them and make a purchase when they are a repeat buyer. So we give them a lot of different tools to help them succeed in that area and build lists and remarket to their customers.
It sounds like you really focus on the sellers and giving the sellers a lot of tools to build their business and to build repeat business.
We absolutely do. We pride ourselves on that.
And it sounds like you're doing those things in very specific areas where somebody's making one or two or three things rather than doing a production of 1,500 items.
Absolutely. We cater to smaller sellers. We also have, a lot of sellers that have larger quantities of items that want to sell on our site tool, just because the tool set that we offer is so attractive.
That's awesome. So tell us about how a seller would go about hooking up with Bonanza.
So they would basically come to bonanza.com, to our homepage, and they would see a link there to where they can get signed up on the site. At that time, they would be given different options, whether if they wanted to create a listing manually or if they wanted to use one of our import tools. They'd be shown a lot of different parts of the site. Our listing form is very easy. It's a one-page form that allows them to set up a listing, and literally, within 2 minutes, they can have a manual listing online and ready to sell.
Awesome. So that's bonanza.com.
Bonanza.com.
That's awesome. Tremendous deal. It's great for small sellers, especially. I mean, the Amazons of the world appeal to the huge sellers. You seem to have a platform for small sellers. And 25 million items.
Yes.
That's incredibly impressive.
Thank you so much.
That's great. So if you are a vendor, if you are a company that is a small company or a medium-sized company that wants to sell, you should check out Bonanza, bonanza.com. And we'll be coming back in just a minute. I want to talk about something that happened 3 years ago on the 4th of July that had a tremendous impact. That's right after the commercial break, so don't go away. We'll be back to talk about that. And you're listening to Mike Adams of Adams Financial Concepts. We talk about money on this program, and we do it each week. The idea is to give you, the listener, insight into what's happening and be ahead of the curve instead of behind the curve. We'll be back right after this break.
For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and, probably most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So, something happened on July 4th, 3 years ago, that's very significant. The Economist pointed it out. The Economist also pointed out when you have historical events, as they get older, they fade away, people begin to forget. You know, with every passing decade, the importance goes away. I mentioned World War II. You know, as each decade goes by, people begin to forget December 7th, the day that would live in infamy. Only a lot of young people don't know about December the 7th. You know, historical events begin to fade away. People forget. Who had the wives, the 6 wives in England? Who was responsible for converting Burgundy to wine? Who converted Bordeaux to wine? They forget about mercantilism and what happened in the 1700s. You know, historical events kind of fade away. People have, in fact, have forgotten a lot about the dot-coms. People have forgotten about October 19th, 1987, when the market plunged down. Those seem like a long time ago. Those are just become blips on progress. But something happened on July 4th, 3 years ago, that had a huge impact. It happened in Switzerland at the CERN Accelerator. In 1964, there was a physicist who postulated the existence of a particle. Name of Peter Higgs, a British scientist. He predicted the existence of what became known as the Higgs boson particle. Some called it the God particle because physics built up all these theories built around the existence of a particle that had never been identified, but was only postulated that it had to exist in order to explain all the things we see in the laws of physics. That particle had to exist. Postulated 50 years ago. That was the theory. 50 years ago, Peter Higgs said that particle has to exist in order for the laws of physics to be true. Now, if that particle had never been found, you could write off all the theories about physics and quantum mechanics, all the things that are involved. But on July 4th, 3 years ago, they found the Higgs boson particle. They identified it. It exists. It's true. They found it. You know, the impact of that is it verified that the theories of physics are real. They're dependable. They're not going to change. It's not going to be something that's forgotten. Those laws are based on realistic things. You know, I can remember 1965 and the front cover of Time magazine had the DNA helix on it. And I was young and dumb at the time. And I thought, that's nice, so what? You know, today, that's over $250 million industry. We're looking at biotechnology. And I built portfolios around a theme. As we came to the end of the last century, I built portfolios around a theme that the 18th century was, or the 19th century was the century of chemistry with oil and aluminum and steel, that the 20th century was the century of physics with the internal combustion engine, with electronics, with computers. All those were physics. The 21st century is a century of biology. And when you begin to think about the things that have been done, it's enormous. Those are the things that are happening. You know, but at the same time, when you look at what's gone on in my industry, and I want to bring it back, there was the idea that began to develop around the 1920s that economics was a science just like physics, just like chemistry, just like biology, that there were certain economic laws that were inviolable. You had a guy by the name of Irving Fisher who wanted to quantify it, put into numbers. You had him wanting to make the law of economics just like the law of gravity. It would always obey these certain laws. It would always work the same way. You had Markowitz that came along in 1952 and did his dissertation paper and identified what's called alpha and beta. You know, as you have stocks that go up and down, part of it is related to market movements, and that's the beta. And then you have what's specific to the company, that's the alpha. So you have those. The market has an impact and the company has an impact. And you can quantify that with some sort of formula, alpha and beta. You know, it's something that was postulated. And from that, You built modern portfolio theory, and modern portfolio theory sounds so modern and so theoretical and so logical and so reasonable. I went to Carnegie Mellon. That's where I got my MBA. Mogliani and Miller talked about the cost of capital and the capital asset pricing model. Again, something that they would like it to have been like the law of physics. You know, they were looking for the God particle of economics, the historical model, the Higgs boson particle. Only it didn't work. Fisher didn't work. You know, Samuelson, built on the work of Kendall of the UK in 1952, looked at stock charts and looked at patterns, trying to determine the laws of economics and the laws of the stock market. You know, you have people like Gene Fama, who I've quoted a number of times on here, who believe that we live in a rational market, a realistic market that obeys some sort of economic laws. We just can't figure them out. You know, all those things go on. But the reality is, we live in a different world, whereas gravity doesn't change because it obeys the specific laws of where we live. Economics do change. We're living in a world where change is disruptive. Change is happening faster. We see companies changing. We see the emergence of new companies like Bonanza coming along. You know, without the internet, there would not be a Bonanza. You know, that had to exist before you had Bonanza. Without payment methods, it wouldn't exist. Those things change, and trying to compare a Bonanza to a Sears or to the general store that existed 150 years ago is a very difficult and a very changing kind of environment. Higgs boson was needed. The Higgs boson particle explained physics, and when Peter Higgs identified and postulated this particle had to exist, you could count on it or rule out all of physics. There's nothing like that in economics. It's an art. It's not a science. It has its own changes that are taking place. And it's not who has the biggest computer that's going to win. It's who's got the greatest art and manages the portfolios. That's my thought. That's my input. And I haven't been proven wrong. So that's where we stand. Again, we're on Thursdays from 3 to 4. We're on Fridays from 3 to 4. And we're on Saturdays at 6. So join us at any one of those times. And if you join us all three of those times, you can hear us repeat the same program over and over again. Until next week, have a great weekend and a great week. I'll be back next week to talk about money.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again for more About Money with Mike Adams here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your